Okay, no, it is a new stream, so. All right, give this 2 minutes for people to get back in here.
Oh,
Yeah, we got to 760 viewers in about 35 minutes. Catches the way the live viewership works is it goes,
yeah,
or,
yeah,
you know,
yeah, yeah, yeah.
I think what happens, like what you're saying, is so meaningful that the
Yeah,
government
right.
can step in.
Yeah, they're like,
like
we can't.
All right, we are back. We are in Vegas. Sam Rowe has given us too bearish of a take on AI, and the hyperscaler sent Dan Ives to rip our power out. So we're back. All right, so Sam, keep going. Give us kind of the main takeaway that'll tease people to go and finish the thought.
Yeah,
Because
so I mean, in a nutshell, and I've written about this, and I'm happy to share it with the viewers.
you
if
gave the
guys want some-
$1 million idea in the break, and everybody missed
Yeah,
it.
yeah, and I'm never gonna repeat it again. And I think I'm glad for the people who hung on. But long story short, all this AI capex that we've been talking about, $600 billion of investments and increasing, is going to eventually start showing up on the earnings announcements of these companies. Yes, they'll talk about cash flow and raising debt and all this stuff. But it's going to really start to become a headwind to profit margins in the next couple of quarters or the next maybe 3 to 5 years. You're going to really see that stuff ramp up and show up as a depreciation expense. And unless companies change something about their cost structure or their revenue growth expectations, really take off, this becomes a really big headwind for the hyperscalers.
So how do they manage it? Is it just saying, look, this is going to depreciate over time and this is going to pay us back ultimately, it's worth it? How will they communicate that on a quarterly basis to try and shore up maybe some of the pressure from the equity holder side?
Yeah, I mean, that's a great question. I mean, everything right now is about the growth, the opportunity. How do you communicate that story? Do they even want to talk about stuff like, how much this is going to cost to the customers, right? Because if we know anything about new technology, new apps, new services, they usually come out and they're introduced at a cost that's, very manageable.
Yeah.
People start subscribing to this stuff, whether it's your Netflix subscription or, use of the Uber app or things that businesses are implementing into their cost structures. It always starts off kind of cheap. And then the next thing you know, once you're hooked, these companies start raising the prices for it. So I think that's something that becomes a little bit more clear. I don't know if it's in the near term, but if they're not able to maintain, earnings growth, then it's not crazy to think that they start charging a whole lot more to their customers and their clients.
Okay, and that's how they make it up on maybe the back end. I do wonder if between now and then, as Nancy was talking about with the kind of competition between the different AI products, if this will also create a new tier kind of within the mags again of who's doing this, the best, who has the best service, who can charge the most.
Yeah, I mean, if we're going to learn anything from, historically, when you have these big game-changing technologies and this paradigm shifts in how we do these things, whether it's the rise of the internet or the railroad, you have all these companies coming out, seeing what the opportunity looks like. They invest a ton of money. You have dozens, maybe hundreds of players come out, and then a couple end up, rising to the top, and the next thing you know, we're only talking about Google search, and we're not talking about Ask Jeeves and Alta Vista and Lycos and a lot of these things that people don't even remember.
Exactly.
But at the time, these were the hottest companies on the planet, and they were leading the whole market higher. And you can say the same thing about railroad companies, 150 years ago. If you want to talk about market,
the name of the game.
That's the name of the game. That's the name of the game. Because if there's something exciting, you got to put money into it. And you have hundreds of railroaders, 150 years, and what we have like 4 now.
Right.
You have thousands of automobile companies in the early 1900s, and that's been consolidated to 3 big players.
By the way, I don't want to stretch this analogy too much, but the only time we had any degree of concentration that we had in the last year was like kind of nifty 50 days. At least from what the research I saw was. And I think a lot of those companies too, now to your point, there's only kind of a few that maybe are making a difference here today.
Sure.
So.
I mean, another thing that's really difficult to forecast, especially when you're a long-term investor, is how many times is a company going to change their business model as the world changes.
Yeah.
Like, we just spent all this time talking about, if you follow the news at all in the last, 48 hours, all we're doing is talking about IBM and COBOL and, all this stuff that, some people understand. But did you know at one point they used to sell computers to
Yeah.
But that's what's so tricky about all this stuff, because it's possible that a company that you didn't think would be huge, it might have been that the case that they were doing something, completely different, not long ago.
Yeah.
So, it's hard to tell, but to your point, things can change very dramatically, and the players that were once market leaders, can become laggards, but someone else will rise up and take that mantle on.
For sure, the active management of capitalism, of the S&P 500.
And then the whole market goes higher.
The last point here on the depreciation side, which is the chart that we're seeing these numbers that are going to go up. Is it clear? How will this correlate to, I guess, earnings expectations? Do we have any kind of clarity for the big companies on maybe what that 1-year trajectory looks like, or what I know you keep in touch with the strategists on Wall Street to kind of try and model these things.
Yeah.
Is there a clear consensus on the direction? Is it up and to the right?
The only thing that's becoming increasingly clear is that the expense line items are going to start to really suffer. It might be a year or 2 or 3 years down the road, but increasingly that's going to start eating into profit margins.
Yeah.
Not right now. All these companies are going to continue to tell you about how their margins are high and whatever, but they're still benefiting from what might be a foregone era.
Yeah. Well, there is a carnage in markets that resembles evolution. That's pretty much what we're describing here, I think. So the fact that we get to bear witness to
creative destruction is not a new phrase.
100%. Sam, great stuff. Great to catch up. Good to see you here in Vegas.
Yeah.
We could keep riffing, and we're gonna do like a poker and markets analysis too.
Oh my goodness
as you
gracious.
get ready for the Money Show poker game. We're going to take a short break. I got Jay Soloff going to talk some options and some income strategies with me with some ETFs. We're going to try and get Jeff Hirsch on as well from Stock Traders Almanac, who's around here somewhere, because it's, I believe, midterm is like we're supposed to be in a negative part of the year anyway. We'll be right back. We're still cooking here. Thankfully, we're not cooking the camera off anymore, but Sam Rowe's cooking with us from TK. Thanks a lot again, Sam. Appreciate it. Be right back.
With increased volatility, investors are bracing for large market moves, both up and down. Will the market rebound 30%, or will we see a 30% drop? At the end of the day, uncertainty remains a constant. Innovator's floor ETFs are designed for volatile markets. They aim to position portfolios for market moves regardless of direction or magnitude. They are intended as a core equity solution, providing exposure to U.S. equities with built-in downside protection, seeking to deliver more than 70% of the upside and targeting a max loss of 8 to 12% annually. With specified levels of sought-after protection and upside participation, we believe the floor ETFs offer an evergreen strategy designed to allow investors to remain invested regardless of the market's direction.
There are two things about Chicago finance you can't get anywhere else. The first is kind of hard to miss. Everyone's trading options. SIBO is on a 5-year growth streak making billions, and its goddess of grain sits atop the final pit of open outcry. And that's what it's all about. The chance to fend for yourself. A fortress for the self-made trader, and the only still standing in America. The second thing you may not know, but it's worth trillions. Chicago is the only major city in America that's home to 2 of the top 10 registered investment advisors, according to Barron's. That means a steady river of passive money and fixed income pouring into the city. If you think you can beat the market, this is where you do it. If you've got value, price will discover you here in Chicago, the future of finance.
Join me, Oliver Renick, from SIBO, Tuesday, Wednesday, Thursday, into the closing bell, live from Chicago. Welcome back to Chicago Future of Finance. We are here in Las Vegas for the Money Show. Let's check on markets real quick, which have been generally pretty solid. Today, you got bonds coming off a little bit. Bitcoin still down about 0.75%. Stocks, though, are looking just fine. We've actually been in pretty decent shape. S&P 500 shrugging off the weakness in coins. Here's BTC right now, down 31% over the last 52 weeks. And today, just struggling to hold on to the mid 60,000 range. It's been a little rough in crypto land, though still holding the line at 60,000. The other thing that I've been watching pretty closely, of course, are the semiconductors, SMH, which is up 1.5% today. Again, the whole reason why the yellow light on my risk radar has stayed for stocks versus the actual red light for crypto is because equities have been holding on in a range that has been well reflected in the semiconductors. Got the red light on Bitcoin, the yellow light on gold. If you look at bonds and the dollar, we haven't gotten a lot of answers. Gold, though, is holding on pretty well, down about 1% today. But after climbing over the last 4 days, gold seems like it's in decent shape. The other thing people have been watching, of course, is silver, SI, a little bit weaker than gold. Let's talk about how to generate income, some ETFs, and some trading and option strategies with Jay Soloff, who is joining me from Investors Alley. Jay has been I guess, a long time contact of mine in the markets now, as we met. What year did we meet at the TD Ameritrade conference, Jay? That was
18 or 19. It was pre-COVID.
pre-COVID. Yeah. And that was kind of TD Ameritrade Network when we had started. I was kind of like in the throes of my options learning and trading days. And it's good to catch up and come full
Yes.
circle here in Vegas,
Yep.
like 7 years later. Yeah. Right.
Time flies.
Tell me about, firstly, kind of what you are looking for on a daily basis, your options experience. You used to trade in the pit in Chicago,
Yes.
tech stuff. You've been with Investors Alley. You are, looking for trading opportunities, looking for what? What catches your eye mostly?
Yeah, it's and it's interesting because options can be used in so many ways, but as a former floor trader, I'm always thinking volatility first, right? I mean, that's as a market maker, you don't care about generally speaking, you don't care what trade is, what side's coming in, call put, right? You're just trying to trade. You're delta hedging, how you're trying to trade the volatility.
Yeah.
So I spent my whole career looking at stuff through the lens of volatility, and then later on, when I was trying to figure out what to do when I grew up, and got into the financial publishing, newsletter trading service business, I thought the thing that would be interesting would be able to take that floor experience about volatility and try to teach people who have been brought into options through various ways, and a lot of times maybe not so successful because it's almost more like lottery tickets and things like that. And I'm like, there's you got to trade with how you're comfortable, but let me try to help you at least learn a little bit of the fundamentals like that I had.
Volatility is an asset class, and as a we're going to talk later today. Me and Matt Fox at Spot Gamma, we're going to talk about the volatility as an asset class. And my kind of baseline that I tell people is insurance. Think about it as insurance firstly. Like the floor of SIBO, ultimately what's going on down there, it's a lot of insurance salesmen and buyers, because there's a lot of buyers of insurance.
Yes.
For a market that's gone up as big as it has, it makes sense for them to just hedge what they own.
Yeah.
But of course, the price of insurance changes very quickly if the environment changes. And that's when you can use them to start speculating. But that's kind of a different category. Now, people obviously love to take advantage of that convexity of options. And of course, we spend a lot of time talking about that on the show as well. But the baseline I feel like people should think about is insurance, basically, and use it as kind of a tool. And then if you start to understand it, okay, maybe then you start to whip it around and wield it a little bit more like a weapon.
Yeah, I completely agree. And obviously there's a perfectly legit case to just buy options and protect yourself. But even that, it's like, do I want to buy the most expensive option out there? Or do I want to try to hedge myself in a way that's maybe a little bit more parsimonious? Maybe, do I want to do it as a spread and not spend as much money and maybe not have as much, downside protection? I was talking the other night about ratio spreads. I mean, it's not the easiest thing to do, and you maybe need more advanced knowledge, but you're probably talking about a lot of tail fund type companies that are, hey, their job is to protect in case black swan, et cetera, happens. How are they doing that without bleeding a ton of money? Well, they're probably selling some options and they're buying some core options further out, and just things like that. How I think it could really help people visualize how it works, even though they may not grasp it right away, and you don't have to necessarily put it in terms of gamma, convexity, data, right? It's all about, well, how much money am I spending to protect myself?
So that's where I would ask from the kind of veteran options trading standpoint is, what are your general thoughts? Like when you talk about with clients or people who are thinking about how to use options in their strategy, there's a lot of now ETFs that have simplified versions of these strategies. You can just buy them and you hold them like a piece of equity, of course, but they're trading options on your behalf. A very popular version of this in terms of the insurance and protection, of course, is the buffer fund.
Yes.
Is one example. But for, there's other ones too. There's, there are a lot of different approaches now that are being packaged into simplified trading strategies.
Yeah, absolutely. The big, most recently structured product. It's something that has traditionally never been available for retail. I mean, you needed what, $1 million to put together a structured product,
Yeah.
and and now some Simplify, Innovator, Couple Amplify. I think they have these like auto callable funds that are doing this
Right.
for you.
Yeah.
And you're just buying the ETF, and they're doing all and you're basically getting the same exposure as what high net wealth institutional investors might have been getting with auto callables. And in other words, it's some kind of maybe worst of basket where as long as one of QQQIWM SPY doesn't go below 30%, then you're going to get paid your 15% coupon or whatever annually. And then if it does go there, as long as it doesn't stay there when it expires in a year or whatever, then you still get paid. So it's actually
a place where I'll also plug the sponsor of the show, Innovator, with the dual direction buffer. You actually will get paid out the best payout scenario relative to the markets if it goes down. Like you can kind of, there's a lot of different forms of this, right? They're all kind of different parts of the elephant a little bit. But at the same time, I do think that's viable for people who want to do it at large scale, advisors on behalf of a lot of different clients. Whereas I feel like the individual person, there probably is still some edge to be gained if you're going to trade options, to learn how to do it and do it very specifically tailored to your portfolio. Like I think a lot of the ETFs generally are more kind of for scale for the advisor world.
And some of them are almost purely speculative. It's like
So that too, of course, yeah.
Single stock fund, cover call funds on Bitcoin or MSTR or something like that, right?
Yep.
And there's some allure because you're seeing like 120% distributions. Of course, what I do, in an Investor Salary is we're trying to teach people like, hey, 120% does not mean you're making 120%, right?
Yeah.
What percent of that is your return of capital? What's going on in the underlying? So, we spend a lot of time on the education front, and that's like, again, with ETFs, like they show what they're doing, but a lot of people, I mean, who's going to read perspective? Perspectives? I will.
Well, of course.
Let's
You've got a few funds that you're watching. I'm going to pull them up as we talk about them because they do hit into the metals and the commodity category, which I think is a good place to kind of conclude the show for the day because we haven't talked about metals too much.
Yeah.
Obviously, a lot of people have been watching GLD, which is down today. You've been watching GLDY. This is from Defiance, but this kind of does go into the discussion about adding on what options strategies, income driven kind of. It's not really like a hedge. Is it a? How do you describe it?
GLDY, they're selling put spreads. So
okay,
it's nice because you have the put spread, so you have that bond. Again, if gold does end up falling off a cliff for some reason, your losses are going to be limited. But with the volatility, the thing about gold that's been interesting, it's not like equities where volatility tends to go up with equities go down. With gold, it's the opposite, right? You look at GBZ, the VIX for gold, right? When that thing flies, gold is going higher.
Yeah.
And so with gold going higher, selling, even though you're selling puts, even though it's moving in the other direction, you're still getting higher volatility. So you're able to capture some pretty good income off cash flow from those. That's going to be mostly profit, not return to capital. So all the metals have been really good about that, just because they keep going up.
And the volatility too, right? Which is also very interesting because I do feel that the kind of risk profile of gold has changed dramatically.
Yes.
Like when you realize volatility is where it's been, even if it's to the upside, everybody's happy.
Yes.
But then you look at like silver and okay, obviously it can happen to the downside. So that becomes a very different product.
Yes.
By the way, SLVO and KSLV are the silver trades you've been looking at, which are income related to silver, right?
The income has been from those, the cash flow from just because the volatility has been through the roof. And again, you have exposure to the underlying. So sure, when the underlying drops 30%, you can't expect the SLVs and KSLVs of the world to also not drop. But at least, you're pulling in a bit on the income side to help. I mean, it's not gonna make up for a 30% drop, but it might make up for 3 to 5% of that, which is still better than if you're just holding SLV on its own.
Yep.
And then when it's going up, these funds, if they do it right, they're going to be selling out of the money and they're going to be rolling them. So you can capture a lot of the upside and also with the income. And in an ideal, when it's trending, that works really well because they have
Yes.
time, right? If it's choppy back and forth, you may not be able to do that. But with the way silver was before it dropped, I mean,
It's kind of I would say this is almost a way if people have been in a silver or gold trade, and they're trying to figure out what to do with it. It's kind of, obviously you're going to take a tax hit if you're going to sell out of something, but if you don't want to be totally out of the precious metal position, it's kind of a way to have your foot in, but still, have the income on top of it so that you have a little bit of a ballast, you have a little bit of a sail in the storm.
Yeah.
It's kind of an alternative to it. But I don't know, I guess you could also, because you're not going to get the bang for the speculation if
Right,
silver does rip, obviously.
yes, yes.
So it's got, it's a different approach.
But one thing I always tell people with these income products is, yeah, if it's something that's going straight up, buy the product, buy a call, do something like that. But also keep in mind that people, including myself, and I've been doing this for whatever, a couple decades, right? I can't time the market. I'm terrible at it. At least with income, you're kind of forced to take some off the table, and you're not
Exactly.
trying to make that decision, right?
Exactly.
So, and then you can, hey, you still think it's going up, you can reinvest it, right? If not, you can just pay your utility bills or pay off Dan Ives so he doesn't turn off the power. Right?
There we go. Great stuff, Jay.
Thank you.
Good eyes. We're going to talk in Chicago.
Yes,
You're going to be in town.
I am.
Good stuff. We'll see you at the SIBO floor.
Thank
All
you.
right. We're cooking. We're an hour in. We got events to get going to at the Money Show here in Vegas. Thanks for tuning in. Appreciate it for part 2 of the Money Show. I'm Oliver Renick. Thanks for watching Chicago Future Finance. Thanks to Joe Soloff, thanks to Tengler, and Sam Rowe for joining me. I'll be back in Chicago tomorrow at 2 p.m. Central Time. Have a great night. I'm going to go and probably play a little poker at the Encore after the Money Show event, of course. See ya.